Hey everyone! Welcome back to the channel. Today we're going to break down one of the most important aspects of your financial life, your credit score. Now, whether you're buying a home, applying for a car loan, or even getting a new job, your credit score is a major factor in all of it. But here's the thing, most people don't fully understand how it works or how to improve it. Well, today we're going to fix that. We'll uncover the truth about credit scores, what they mean, and most importantly, how you can boost yours fast. Let's dive right in. First things first, what is a credit score? Well, a credit score is a number that represents your creditworthiness. In simple terms, it's a way for lenders to see how likely you are to pay back the money you borrow. The higher your score, the better your chances are of getting approved for loans and credit cards, and often at a lower interest rate. Credit scores range from 300 to 850. A score above 700 is generally considered good, while below 600 might make it harder to get approved for credit. But here's the twist. Your score isn't just a random number. It's based on 5 key factors. Let's break down the 5 factors that impact your score and how much each one matters. Payment history, which is 35%. This is the biggest factor, making up 35% of your score. It tracks whether you pay your bills on time. Late payments, defaults, and bankruptcies can significantly hurt your score. So the key takeaway here, always pay on time, even if it's the minimum. Credit utilization, which is 30%. Next, credit utilization makes up 30%. This is the amount of credit you're using versus how much credit you have available. Ideally, you want to keep your utilization below 30%. For example, if you have a $1,000 credit limit, try to keep your balance below $300. The lower, the better. Length of credit history, which is 15%. The longer your credit history, the better. This makes up 15% of your score. So, keeping old accounts open and active can work in your favor. Even if you're not using a particular card, don't close it unless you really need to. Types of credit in use, which is 10%. This one's a little less obvious, but it accounts for 10% of your score. It looks at the variety of credit accounts you have, like credit cards, loans, and mortgages. Having a mix of credit can be beneficial, but don't open accounts you don't need just to improve your score. Finally, new credit. Every time you apply for new credit, it can cause a small dip in your score. That's because it represents risk to lenders. So opening too many accounts in a short period of time can hurt you. It's okay to apply for credit when you need it, but avoid doing it unnecessarily. Now that you know the factors that impact your score, let's talk about some common myths around credit scores that might be holding you back. Will checking your own credit will hurt your score? False. Checking your own credit is called a soft inquiry, and it doesn't affect your score. You can check your credit as often as you like without worry. Does closing old credit cards improve your score? Actually, this can hurt you. As we mentioned earlier, the length of your credit history is important. Closing old accounts can lower your score because it reduces your available credit and shortens your credit history. Paying off collections immediately will raise my score, not necessarily. While paying off collections is important for your overall financial health, it may not have an immediate impact on your score. It's still a good idea to pay them off, but it may not instantly improve your score. I have to carry a balance on my credit card to improve my score. Another myth. Carrying a balance actually costs you money and interest, and it can hurt your credit utilization ratio. You can improve your score by paying off your credit card balance in full each month. Now let's talk about what you can do to improve your credit score. And yes, these steps can actually make a difference fairly quickly. Pay your bills on time. As we mentioned, your payment history is crucial. Set up automatic payments or reminders to ensure you're never late on a bill. Pay down high balances. If your credit utilization is high, try paying down credit card balances. If you can't pay it all at once, focus on paying down the most expensive balances first. Dispute errors on your credit report. Sometimes errors show up on your credit report. Mistakes happen. Check your report regularly. You're entitled to one free report each year from the 3 major credit bureaus, Equifax, Experian, and TransUnion, and dispute any inaccuracies. Become an authorized user. If you have a family member with good credit, ask to be added as an authorized user on their credit card. You don't need to actually use the card, you'll just benefit from their positive payment history. Don't open new accounts unnecessarily. Each hard inquiry can ding your score. Only open new credit accounts when you really need them. So, how long does it take to see improvement? Well, it depends. Small changes like reducing your credit utilization or paying bills on time can show results in as little as a few months. But bigger changes like fixing errors or addressing major delinquencies can take longer, up to a year or more. The key is consistency. Improving your credit score is a marathon, not a sprint. But with the right strategies, you can definitely see progress. Thanks so much for watching. If you found this video helpful, be sure to like, subscribe, and hit the bell icon for more tips on personal finance. Drop any questions you have in the comments, and I'll see you in the next video.